You know, the one professional partner that most people don't seem to really have like nailed down. You know who that is, Steve? It's an
Me.
accountant. It's an accountant.
Yes.
You know, we have our plumbers, we have our lawyers, we have our HVAC, we have our mortgage broker, realtors in many cases. But for whatever reason, it's so hard to find an accountant. And then when you also try and find an accountant that focuses on real estate, it's even more rare. It's like a damn Waldo in the largest page you've ever seen, and you just cannot locate them. Well, everybody, we have Steve Tsonev with Finngo, and I can tell you that I don't love to change the partners that I work with. I really don't like it. I like to keep my partners that treat me well, I treat well, and I just want to stay with them forever. I'm huge on building deep relationships and not bouncing around, and I think there's a lot of value you get with that. I've been with my accountant before Steve like 6, 7 years, just treating me like gold. I was afraid when the time comes when he dies that I wouldn't get the same service. And I recently just switched over to you, Steve, and it's been a fantastic experience. And we've been talking about real estate accounting now for about 2 years minimum, I think, with our team and doing videos. And I'm really excited to see what you've built and how much of an impact you've made.
I'm very happy to hear that you are having a good experience. I mean, as any other firm in the growth stage, we hire staff and we set up systems and processes. And knowing that that is actually working and the end client has a great experience is awesome to hear. Our industry is a little bit difficult to find someone because there is a huge shortage of accountants. And I think the last statistic I heard was that for every accountant out there, there are four available positions. So it is very competitive and very difficult to find someone. But once you do find that gold person that, not just they have the knowledge, but they also communicate in a style that, resonates with you, keep them and make sure that, keep that relationship going for as long as you can.
Absolutely. Now, we get the question all the time. When I'm an investor, I'm buying my first property, or it's my fifth or my 10th. Should I incorporate? Should I keep it in my personal? Can you publicly announce the difference and how you approach that situation with a client that you're working with?
Yes, I would say, kind of planning for this, I was thinking about it, and I have a call probably 5 times a week with someone asking me, should I incorporate or not? And like everything else in life, the answer is it depends. But today I'm going to try and give you some tips that might lean you one way or another. I think I would probably start by saying you really need to decide why do you want to incorporate. Because let's start with the type of income you earn. If you earn active business income, and what is that? That would be your flippers, your wholesalers, your short term renters out there. Incorporating would be a pretty great way to reduce your tax every year. You would fall into something called the small business deduction for your first $500,000 of profit, which is quite significant. And you only need to pay 12% tax, which is amazing. So that leaves you with extra cash flow. Now you can take that money and invest it into other deals. But for someone that loves long-term holds, for example, and that falls into the category of passive income, it makes it a little bit harder because the tax rate in a corporation for passive income is something that I call a penalty tax rate. They charge you almost 50%. Now, it is true that out of that 50, give or take 20% is permanent tax and 30-ish is refundable. But those refunds only come to you when you issue dividends to the owners, which essentially flows through the income back to your personal side. So why are we doing all this administration and paying for for two tax returns, keeping the company alive, the initial incorporation costs as well, if in the end of the day we're still going to pass it right back through to your personal name? So really understanding where you're coming from would make a big difference about that.
Absolutely. Absolutely.
What do
And
you
so,
think?
I mean, I know that I incorporated property. I think it was when I was on my property four. And at that point,
Yes.
the accountant felt like, hey, at this point, you can see some bigger benefits as you start to build up a little bit more of a, I guess, like a maybe like a net worth of
Yeah.
rentals. And so there was that tipping point where it made sense. And what I would do with my accountant at the time, before I met you even, is just check in every single year. You know, are we in a position
Hmm.
where you think I should incorporate, or when you're looking at my taxes, do you recommend that I keep it under my personal? And so it took a couple years, and I wasn't in a rush. I just wanted what was best. And even right now, if it made more sense to be personal, I would have just stayed on personal. But you know, it is nice to have the incorporation, and I have seen some great benefits because of it. But just like you said, it really does come down to the person that you're dealing with. And I know people hate the "it depends" answer, but I mean, that's the reality is we want what's best for you. And that's what Steve's going to
Right.
do, is actually take the time to look into you.
Well, there are other considerations as well. And, I mentioned to you, yes, your rental property, long-term rental property would have that penalty tax rate, and everything is going to flow through. You have more expenses because you're paying for two tax returns and all that. But you may decide that you want to budget for that, and your cash flow can still afford it. So no issue there. Now, the question is, what other benefits you can get. And if you ask a lawyer, and let me tell you, I'm not a lawyer, but they're going to tell you there is that extra layer of liability protection. Now, that liability protection is not for your debts. So imagine if you have things like mortgages, lines of credits that are secured with that property. Most of the time, even though it's in a corporation, you would still be personally guaranteeing it. But there could be other things. Your tenants have guests that walk by and slip and fall or whatever. And yes, there is insurance, but remember, the job of the insurance is to not pay anything.
Mm-hmm.
So, some people may feel comfortable that, yes, one property is not worth it, but at four, now I have, let's say they're suited house, I have 8 tenants, my risk is growing, therefore let's start mitigating that risk and I'm willing to pay for it. So
Mm-hmm.
that could be something that we take into account. But then that brings more questions into the equation. What can we do from the accounting side to reduce and minimize the tax or defer it where we can? So some other things that we would kind of layer on top of your corporation would be taking depreciation and capital cost allowance and explaining it to you. Does it make sense or does it not? Usually on the personal side, we say not necessarily, particularly in your earlier years when you're not earning as much, because you're saving on the lower tax rate, and then that amount gets added to your income at a later point when you sell your property. But at that point, you might be at a much higher tax rate because years have gone by. You now have seniority in your positions that you've worked with, etc. But on the corporate side, you're already at the maximum. You're like paying literally 50%. So what can we do to get rid of that altogether? And CCA could be actually something quite beneficial in that scenario. There's also another consideration. It was going to come down to your lenders, and do you want to get that deal done? Some of my clients will start with one or two properties as, townhouses, then graduate to a single family, then maybe move on to like a suite duplex, so like 4 units. And then eventually they come to a point where they're like, oh, I do want to move into multifamily, something that is 5 units plus. Our most common are the 6 or 8 plex MLI select type of deals out there. And more likely than not, the lender is going to say, in order for us to fund this deal, you need to have a corporation because they want to isolate their liability. And you'll have no choice but to get it done. And let me tell you, it's even though it does cost a little bit of money to get it done, it's always better to have a deal than not have a deal. So we will just
Mm-hmm.
account for it and budget for it and, make a plan.
Absolutely. What are some questions that someone can ask? So someone that's watching this video right now, is there a list of questions you can get them to ask themselves, and then based on their responses, it can lean them into incorporation? Is that possible? Could you have something on your
Yeah.
website even where it's like, these are the questions, and if you score this or if you answer this, then I would incorporate and have the conversation with me. And if you don't, then maybe keep it in your personal as you have it right now. What would that look like?
I think the number one would be, what type of income am I earning? Is it
Okay.
active or is it passive?
Okay.
And again, let's just go over those. What is active? Active would be your wholesalers out there, your flippers. Like if you're making multiple, like if you make one, maybe not so worth it. But if you're making like 3 or 4 flips a year, incorporating might make a lot of sense because now you are paying that lower tax rate.
Right.
Then the other one, so we have the wholesalers, flippers, And what else? Oh, short-term rentals. Yeah. So if you have short-term rentals, particularly multiple, like you are profiting from them, maybe in the beginning you're not profiting so much, but later on you have like maybe four now, and all of a sudden, oh my God, I make like 60,000 each, times four. That's pretty significant. We should probably consider an incorporation for you. If you have passive, it's not as urgent, but you might want to start thinking about it as well. Next question you would ask yourself, how big of a deal am I doing? Like, am I doing just residential or am I moving into multifamily? And when you're moving into multifamily, I'm not saying immediately you're going to be asked for a corporation, but it would be good to start understanding and knowing how exactly it functions. And maybe lastly, the third one would be, am I getting pushback from the lenders? Are lenders telling me you have capped out and you can no longer, like maybe you're at that 7 to 10 properties in your personal name and they just don't want to fund any more deals for you? Again, much better to have a deal than not have a deal. So it's a great time to start considering incorporating, because at that point, they may be able to move you into commercial lending. Therefore, you could just get more properties.
Hmm. Hmm. Can you add these? I think these questions, if we can even have them in the comments of this Facebook Live, I think it'd be nice for somebody to be able to ask them, and then you can put your contact information below. And if they have any further questions or want to know what the next step is, I think that could be really, really beneficial as
Absolutely.
well.
I mean, like we said earlier, everybody's situation is a little bit unique. Some people have really low income or no income from other sources. Other people make $200,000 a year, and maybe they already are personally at their highest rate. So it doesn't matter to them, is it going to be a corp or not? So I would probably say, yes, there will be questions, but definitely scheduling a call with myself or anyone else that understands what we're talking about here is going to enlighten you a lot more, because they're going to look at your situation, ask you things that are unique for you, leave notes on your file, and then maybe give you a plan or like give you some kind of marker and say, okay, once you pass this point, get back to us because you would be a very good candidate to incorporate.
Hmm.
So I would definitely say do the research on your own so you understand what's going on, but that's why you have professionals around you. And for the most part, your initial calls are free. Like you're just tapping into someone's knowledge that has been doing it for over 10 years or however long, and you're applying all of those skills to your situation. So take advantage of it where you can, kind of like a realtor. If the clients don't really pay you, you can go out and represent them, and why not take advantage of that?
Hmm. Absolutely. Yeah. Yeah. And if people want to meet you in person, Steve, where are you going to be next?
Well, looking forward to Recon September 6th and 7th. Quite excited. We're going to have a nice booth with a lot of little freebies. So make sure you come and see us. They're going to be a lot of fun. And then we will be able to maybe chat with you for a little bit. I'm bringing a couple of people from my team there as well. So it's not going to be just me. We'll have a few of us. We're also hosting one of the breakout rooms. So quite excited to see everyone there. We're going to be talking about financing and accounting, and there will be a lot of opportunity for Q&A. So bring your questions. It's going to be a great time. You're going to learn lots. So definitely notebooks and little, things to remember, and then follow-ups. Like you're going to meet so many people there. You should make a plan. How do we actually execute this? Because it's not just about saying, oh, I should do that, I should do the other. Just make a plan and start doing it one thing at a time.
Hmm. Hmm. Absolutely. I'm going to do a bonus question for everybody that's
All right.
watching. Okay. My bonus question that has nothing to do with incorporation, maybe a little bit,
Okay.
are what are the things that you can write off when you have a rental property, and what can you not write off when you have a rental property?
Okay. So, in a contextual way, you can write off anything that helps you earn income. It doesn't matter what it is. It like as long as you can substantiate how that item helps you earn income. I have a really great example because I met this person at a conference a few years ago, and she's a speaker. She's a public speaker. The organizer just hired her to motivate people at that conference, but her signature is wearing red heels. It doesn't matter where she goes, she always has red heels. And normally, CRA will not allow you to claim anything that is clothing related or attire because everybody needs to be dressed to go out and do things. However, in her case, it is part of her marketing. So purchasing red heels makes sense in that scenario. Not saying that's exactly like you could do that for your rental situation, but if you're doing something unique and you're thinking, oh, should I be claiming this or not? Ask us, because if we can find a good tie-in into you earning income, most likely we can deduct it for you. But then let's talk about the other just regular expenses. We have your bank fees and mortgage interest. That's your number one and your biggest expense usually. You have your insurance. And with insurance, I just want to tell everyone, be mindful of what is the coverage period of your insurance. Is it a calendar year? Because most likely it's not. And if it's not a calendar year, we probably need to prorate it and figure out when we're doing your personal taxes which portion of it falls within the calendar year and which one out, and then basically kind of keep recalculating that every year. We have your property management fees. Those tend to be quite major as well. Repairs and maintenance, and then capital expenses. We have to split those. So understanding, am I just bringing something back to its original value, or am I adding something new that didn't exist before? So help us figure that out. We will, inquire around it, but repairs and maintenance tends to be a pretty big one. And then utilities, if they're covered, depending on how you have things set up. Property taxes, they're a pretty big expense as well. Not your biggest one, but it should definitely, it's like something that's guaranteed. It's there every year. And then we have like your extra expenses, and those would be things like your mileage and travel, things that are connected to you somehow managing that property. And the reality is you cannot just say, oh, here are my gas receipts and I can write that off. What I really need is some type of log that tells me how long or how many kilometers you're actually spending for these rentals, perhaps compared to your regular driving, like just for either work or personal use, because then we need to figure out a ratio. So for anything that is travel or mileage related, ratios are important. We need to have a work paper that kind of substantiates how was that calculated. And the second one that also uses ratio would be your home office expenses. A lot of you spend time on weekends dealing with tenants, dealing with maintenance requests, educating yourself, etc. That would qualify. We know that you don't use that office or that kitchen table 100% of the time for your rental. So we need to discount for the time that you actually do use it.
Mhm. And what about the cell phone? I'm calling my tenants. Can I write off some of my cell phone bill?
Yeah, absolutely. What I would say is take take a sample, like a month or a quarter or 6 months, and look at your usage. Look at how much of your phone you're using for your rental portfolio. And it's not just your tenant. It's going to be calling your tenant, calling a property manager, calling, all these trades that you need to get in there. Depending on what you do, there may be more or less of a ratio. So if you're doing long-term holds and there's not much going on, probably a smaller ratio. But if you're doing something like a flip and like you're on the phone 5 times a day dealing with fires, literally, you would probably have a much larger ratio.
Amazing. Amazing. Rental advertisements.
Absolutely. Yeah, that's definite. Yes.
Photographer to take rental photos.
Yes. That kind of
Camera.
falls in advertising. Camera would be a capital asset. So that would be something that we would need to depreciate over time and know, are you using this camera just for your rentals or you're also using it when you go to your Hawaii vacation?
Absolutely. The lawnmower you buy for the property so the tenants can mow the lawn.
Technically depreciable asset. Again, we have to kind of split it over time. But if it is staying only in that rental property, then it would be 100% depreciated. If you're also using it in your personal, we would depreciate it plus use a ratio to reduce it a little bit.
Short-term rental, Netflix and Amazon Prime.
And those are write-offs, yes. Not your
Fantastic.
personal use, but yes, for your short-term rentals, that definitely.
The bed sheets, the plates, the towels.
Yeah, that would be something that has an extended value. So it would fall under your capital expenses, but we can depreciate it over time for you. Yeah. And it's 100% because it is for your business essentially.
And management costs.
Yes, management costs, one of your bigger expenses. Definitely keep close track of those and make sure you understand how much you're paying for it.
Do you have a sheet that you can give investors on how to stay organized with their bookkeeping on a monthly basis?
Actually, yes, I'm working on an updated version. We will definitely be releasing it before Recon. So when you come and see us, we'll have a couple of little QR codes for my link tree. Right now, on my link tree, I just have some podcasts. Like, for example, this recording is probably going to show up on there. But we will be adding some resources that you could use for, just keeping track initially for things. As your portfolio grows, it's going to become more complicated. You may not be able to do it in a spreadsheet, but at least for your starting point, we'll have something available for you.
Amazing. Steve, always providing so much value, so much insight, so much experience, and I'm excited to see you on stage at Recon September 6th and 7th. You are the go-to accountant, and I'm hoping you have a chance, if you haven't met Steve, take the opportunity, go to his booth, go see what's going on. He'll give you some great tips, dive into your personal situation, and make sure you're set up. Because the biggest thing that we want to know with accountant is that there's nothing left on the table for me, and everything's being
Absolutely.
considered, and no one wants to get audited. So you're going to help
Yep.
with all of that. So, Steve, we're going to
Absolutely.
see you very soon, September 6th and 7th. Thank you so much, my friend. Always so much value.
So excited. See you then.